All right, let's shift our discussion now to the mainland banks, and of course, highly exposed to the trade war, the tariff war with the United States. How are they faring?
I think, okay, so firstly, for most of the major China banks, they generate their revenues from the domestic operation. I think except for PBOC Bank of China, all the other major China banks generate most of their revenue from the domestic market. So they are not directly impacted by the US tariff. However, as the China banks closely correlated to the overall China economic growth, it will definitely be indirectly impacted. They may be faced with lower loan growth if the GDP was negatively impacted in China, and also they might be faced with a NIM downward pressure given there will be loosening monetary policy to support the economy, and they may also be faced with an asset quality deterioration because the borrowers may be exposed directly to the export and import business and may face some pressure in their revenue generation and cash flow generation. So that's the key pressures on China banks in the tariff. We have done some scenario analysis, and we think that given that the China banks have high provision level on the NPL, like the current provision coverage level for China bank system is more than 200%. So we think that the overall earnings impact on China banks in the current tariff situation will be manageable, like a low single-digit earnings impact on the major China banks' earnings. Even if the NPL ratio goes to 1.85 or 2% from currently 1.5%. And the 1.85 to 2% is benchmarking with the 2018 trade war and the 2020 COVID level.
So you do expect NPLs to be under pressure with what you were talking about, the asset quality pressures with the trade war? If the economy is subject to more stress, how bad would the NPLs get?
As we mentioned, the current NPL ratio for China banking system by the end of FY24 is 1.5%. And we have, if we looking back for the such economy negative shocks, so during 2008, we see that the NPL cycle that it peaked during 2018, that round of trade war to 2020 when the COVID breakout. So the NPL ratio at that peak period was around 1.85 to 1.95%. So if you think that the NPL ratio to go from 1.5% to 1.85 to 1.95% there, I think the current provision coverage can still absorb the potential asset quality deterioration. And I think the key sectors that will be affected is manufacturing and logistics and transportation and wholesale and retail, these three segments on the bank's loan book. And these three segments, they make up of around 25% of the total loan book. And if the we also have done some scenario analysis, like if the NPL ratio in these three segments get doubled, and the asset and the NPL ratio for the rest also get some increase, then the result is also around 2% for the NPL ratio assumption in the worst case scenario.
We heard from the PBOC yesterday that they intend to continue to implement an appropriate loose monetary policy. What does that mean for the China banks?
Okay, so our DBS house view expects that there will be 15 bips of rate cut in the second quarter and a total of 30 bips rate cut in 2025. And I think that will, of course, bring further NIM downward pressure to China banks, but that should be largely within the expectation. And we think that For 2025, of course, the China banks will continue to be faced with some NIM downward pressure, but that will also be partly offset by the lower funding costs and lower deposit rate. And overall, we are expecting China banks, like major China banks, to see a high single digit to low teens of bips of year-on-year NIM downward in 2025, and that's narrowing from what we have seen for 2024.